waiting till my second vaccination so I can go out and eat.
Right. Okay. Hi, everyone. I think we're on. Live. Hi, everyone. Welcome to tonight's episode of Endowus Live. With me is Sinting. My name is Greg. I'm the CEO of Endowus, and tonight we'll be talking specifically about saving and investing for expats in Singapore.
Hey everyone. Greg and I are both from Hong Kong originally. We've both been living in Singapore for about 10, 11 years now. So, I guess we're still considered expats. No, I'm a PR here in Singapore. So this topic is very relevant to us as well.
Awesome. Cool. Let's get started. If you guys have questions, we'll be monitoring Slido. So all you have to do is type in Slido 512412, and you can upvote questions there and see. Yeah, you can upvote questions there, and we'll try to answer your questions as we go along in the presentation. Really quickly, a shout out for next week. We have a webinar on China. We have a number of Chinese strategies now available on the Endowus platform. And on a regular basis, we invite fund managers, professional fund managers who manage these funds. Many of these funds are lowest cost at Endowus versus any other platform in Singapore. So next week, we're really excited to invite Aberdeen and Allianz on to talk about their Chinese strategies, and particularly a very hot topic right now around China's regulatory crackdown, which we've been seeing around the world. Really quick introduction to Endowus. We're on a very simple mission to help people invest better so they can live easier today and be better prepared for tomorrow. Now, this is very different from, let's just say, creating a low-cost brokerage platform where you can buy stocks. There are plenty of those that exist. What we're focused on is really wealth management for yourself and your family so that you can live with more ease today and be better prepared for your future. So think of us as a wealth platform. Today we are probably the preeminent fee-only wealth platform in Singapore and remain the first and only digital advisor for cash, CPF, and SRS. Now, CPF is probably not too relevant tonight. SRS is very relevant tonight, and we'll be digging into that in more detail later in the presentation. We've recently received external capital from the likes of SoftBank Ventures, Lightspeed, so two global venture capital firms that are leading in their field, as well as strategic investors. UBS, the largest wealth manager in the world, made their first fintech investment in Asia in Endowus just a few months ago. Samsung out of Korea, and something closer to home, Singtel. So we're really honored for them to have selected us as their partner, and we really hope to sort of transform wealth management with their support. Endowus has been recognized by various publications for our achievements. And basically, we're trying to make wealth management easier for everyone through our mobile app or our website at endowus.com. So please check us out if you haven't done so already, or if you're not yet a client. Cool. So expat considerations. I'm going to hand over to Cindy.
Thanks, Greg. So just a little bit about myself. So I'm the Chief Client Officer here at Endowus. And I started my career in the wealth management space in Hong Kong at Morgan Stanley. And I moved to Singapore about 11 years ago now. So I'm a Hong Kong citizen, and I became a PR in Singapore about 4 or 5 years ago now. And even though, being a PR in Singapore isn't really permanent, I have to renew this every 5 years. I wanted to give myself, more options and not be tied to a company for an EP. We're all global citizens today, but I could also really see Singapore as one of my home bases, and I also think it's a really great place to start a family. But being an expat here, there are some additional considerations that we have to take into account. So foreigners make up, about 30% of the population in Singapore. Although it has been a little bit more challenging for expats in the last year, the decline, the number of EPs that have been given out, and S passes as well. So it is really important for us to get our finances in order. Greg, if you go to the next slide. So Singapore has been ranked by HSBC as the second best country to live and work in. And some of the additional money considerations I've taken into account and be mindful of as an expat here is that, firstly, a lot of us, have to juggle financial commitments, bank accounts, and investment accounts across different current countries. We have to manage our currency allocation. Estate planning becomes a little bit more complicated when you have cross-border assets. There are more tax implications you have to think about. And at the same time, we, as a foreigner, also, we have to invest and make our money work harder. So in today's webinar, we're really going to focus on the last 2 points, more on taxes as well as investing as a foreigner. And honestly, we're quite lucky to be based here in Singapore. And even if I choose to, move back home one day or move to another country to work, it's quite likely that I would choose to keep my Singapore bank account as an offshore account and my investment account here, because Singapore has a very strong regulatory infrastructure, stable currency, capital controls, and a very favorable tax regime with no capital gains taxes here. And we can jump back to this point later. You can go to the next slide, Greg. So on taxes, Benjamin Franklin once said, nothing is certain in life except for death and taxes. And it really couldn't be more true in the last 2 years with all the uncertainty that has happened. Next slide. Luckily for us, the tax system in Singapore is pretty straightforward and easy to understand. Unlike the US, for example, most of us living here don't really need to hire a tax advisor to file our taxes. So personal income tax in Singapore is one of the lowest in the world. And it follows a progressive tax rate that starts at 0% and it ends at 22% for income above $320,000. So individuals in Singapore are only taxed on income that's earned in Singapore. And at the moment, there isn't capital gains tax or inheritance tax. If you go to the next slide, it's just a quick demonstration of what the different effective tax rates that various income brackets would pay here based on Singapore's progressive tax system. So if you make an income of $150,000, your effective tax rate ends up being 8.3%. If you have an income of $500,000, your effective tax rate is just a little under 17%. Next slide. So there are different avenues here for tax reliefs for individuals, and this is capped at a tax relief cap of $80,000. There's several, non-discretionary items here, such as, earned income relief, your parent relief, spouse relief. But to be honest, a lot of this is a lot more applicable for Singaporeans and PRs. It's really the discretionary items on the right that are more applicable to expats. So, donations is pretty straightforward. You can claim 2.5 times of whatever you donate to registered charities here. But the other big item that, we're going to focus a lot on today is SRS contributions. So here, the next slide. SRS stands for the Supplementary Retirement Scheme. It's a voluntary savings scheme for retirement that's designed to complement the CPF system here. It's actually not part of the CPF, and it's administered by the tax authorities in Singapore. So CPF is only for Singaporeans and PRs, but SRS is available for everyone. So Singaporeans, PRs, and foreigners. So the main advantage of contributing money to SRS is the tax relief that you receive. So Singaporeans and PRs have a contribution cap every year of $15,300 to their SRS account. And foreigners have a contribution cap of $35,700 each year. So any amount of money that you contribute to your SRS account will reduce your income tax in the following the year of contribution on a dollar for dollar basis. This is still subject to a cap on the total personal income tax relief that you can claim every year of $80,000. If you go to the next slide, I wanted to show you what this actually means in numbers. So I've used the same, income brackets that I had shown a couple slides back, right? So if you're making the income of $150,000, which translates into an effective tax rate of 8.3% without any SRS contributions, you max out your SRS contribution of $35,700. So your taxable income goes down from $150K to $114,000, and your effective tax rate drops down to 4.86%. So if you made an income of $250,000, your effective tax rate goes down from about 12.28% to about 9.55% if you had maxed out on your SRS contribution. It's actually a 22% in tax savings. So if you go to the next slide.
Just, Cindy, really quickly, I wanted to show everyone that actually they can calculate what their tax savings would be on the Endowus website. So we actually have, if you guys go to the Endowus website, we have an SRS page. So you just come to Endowus and you go to Invest SRS, and you can read more about SRS investing with Endowus. And when you come down here, you can state whether or not you are a Singaporean or a PR. So, Singaporean PR or a foreigner. And when you select foreigner, you can say, I make an annual income of $150,000. And, what are my eligible tax reliefs? Let's say I have none right now. And how much do I want to contribute to SRS? This is capped at $35,700 for foreigners. So if I contributed $35,700, I would immediately save $5,155 in taxes by contributing to SRS. So that's automatic by the Singapore government when they give you your tax bill. They will already know how much you've contributed to your SRS. And the SRS contribution can be done at one of the three local banks, UOB, DBS, or OCBC. So you set up an SRS account, you deposit money there, and they will already know that you've contributed. And then this is how much you will save of your total tax bill. So check it out. It's a fun resource. I will get back to Sinting's presentation.
Thanks, Greg.
Yeah.
Yeah, so as Greg mentioned, if you do want to contribute to SRS, you have to open an SRS agent bank account with DBS, UOB, or OCBC. It's a pretty straightforward process. You can do it online. I would recommend you pick the bank that you already have online banking with, just to make things a little bit easier, because the functionality is all the same. And then you can link that SRS account to any broker or investment platform like Endowus to actually invest your SRS money. So SRS it's a tax deferment scheme. It's not a straight out tax reduction scheme, right? So what that means is that, you can start. So when you start withdrawing from your SRS, after you reach the statutory retirement age of 62 years old, 50% of the withdrawal amount is actually taxable. So just note that it's the entire amount that's taxable, right? It doesn't matter if it is, your capital gains or income or your initial contribution. And I'll touch on this in the next few slides. There's also a special concession on withdrawals for foreigners. So for SRS withdrawals, you can spread this out across a maximum of 10 years. And it makes a lot of sense to do that, because the assumption is that, you have very low or no income at retirement or when you start withdrawing. And currently, the first $20,000 of your income in Singapore is tax exempt. So that means that, if you, in year one, if you withdraw $40,000, 50% of that is taxable, which is $20,000, and you have no other sources of taxable income, it means that, you won't pay any taxes on the actual amount that's withdrawn. So you could theoretically withdraw $400,000 in SRS over 10 years without any tax liabilities. Obviously, this assumes that you have no other sources of income when you start withdrawing. If you go to the next slide. So unlike the CPF system, your money isn't actually locked into SRS. So you can technically withdraw at any point if you really need the money. So it is a liquidity option. But if you withdraw this prior to the retirement age, you have to pay a penalty of 5%, and all of the withdrawal amount will be taxable. I personally think this negates a lot of the benefits of contributing to SRS in the first place. So it is important for you to really think about, whether you need the funds in the short term prior to contributing to SRS. So there are, some exceptional circumstances where you can withdraw prior to retirement age and not pay a penalty for it. Such as, there are certain medical grounds, in terminal illness, you can withdraw penalty free. But generally, you can only withdraw after you reach the retirement age without paying that 5% penalty and additional tax liability. Sorry.
So let me just a quick story here. So when I moved to Singapore as a Hong Kong person, I set up my SRS account, and actually a lot of the multinational companies, I was working for UBS when I first came to Singapore. So UBS actually hired me as an EP in Singapore. And a lot of the MNCs, UBS in particular, UBS is my example, have a policy whereby if you contribute to SRS, they will have a matching scheme. So ask your HR about that. I think it's becoming a more and more common practice, because with CPF, for example, for Singaporeans and PRs, employers have to contribute to the CPF program. When it comes to SRS for foreigners, basically the employers are not taking care of foreign hired pension as much as they are for the locals. So at some of the companies, there's going to be a matching up to a certain percent, or they'll match 30% or 40% of whatever you contribute to your SRS up to that cap, which I spoke about earlier, that
35,700.
The 35,700 cap for foreigners. So that was amazing that was an amazing program. And if you were ever to, and then the beauty of that as well, we're talking about the penalty here. If in the future, you determine that you actually need that capital soon, the penalty is 5% of that total amount you put in, and 100% of the amount that you withdraw will be taxable. So let's say I put in for 3 years and I now have $120,000 in my SRS. If I took out $120,000 of my SRS and my employer contributed, let's say 50,000 of that, I'm going to be penalized on that 120,000, only 5%, and the entire amount will then be taxable. But as an individual, I would have, gained, because the employer had helped me achieve my retirement goal. If I leave Singapore for whatever reason, I mean, I think we'll cover that later. This is a totally flexible, it's actually a very, very flexible system that people should take advantage of. It has immediate tax deferment. Employers have programs around the SRS system, but you need to ask for them. You need to ask about it as a foreigner. They don't advertise it very well internally. So go back and ask your HR. And the penalties are not huge. And I think it's a very fair system in that if you do withdraw early, you're just taxed 100% of what you would have been taxed anyhow. Yeah.
So I actually had the same arrangement with Nomura when I was working there before I became a PR. So at Morgan Stanley, we had our internal sort of pension system for foreigner, but Nomura, that didn't exist. So for foreigners working there, the bank would match what I contributed to SRS up to a certain amount, which was amazing. But just like one thing to note is that your employer's contribution into your SRS, it does make up part of your remuneration in terms of tax, and this has to be declared by your employer, which they will do for you. Jumping back, sorry, Greg, if you go to the next slide.
Yep.
Yeah. So there is a special concession for foreigners in that you can withdraw in a lump sum after you have maintained your SRS account for more than 10 years. Right. So foreigners here does not include PRs. And if you do that, there's no penalty for early withdrawal. You don't have that 5% penalty, but you do have to withdraw all of it in one go. And the other rule is that you cannot have been a Singaporean in the last 10 years before the date of withdrawal. And then 50% of that amount will be subject to tax. Yeah. So actually it makes a lot of sense as a foreigner, if you are thinking about SRS, that, you can make a small contribution first, because that actually starts the 10-year clock. Yeah. If you go to the next slide. So, SRS contributions have grown quite a lot in Singapore over the last decade, from about, 3 billion in 2011 to over 10.5 billion today. The most of, SRS account holders are still Singaporeans. About 6% are actually foreigners. Interestingly, if you go to the next slide, Greg, actually, over 30% of SRS monies are in cash, which to us, doesn't make a lot of sense, because if you leave your SRS funds in cash, it only earns you 0.05% per annum in interest, which means that on an inflation-adjusted basis, you're actually losing money every year. So it really doesn't make sense, because, SRS money is meant to be long-term funds. You have a longer term investment horizon, and you should be able to take more risk for higher expected returns over the long term, because you can sit through various market cycles. And this is something that Greg is going to touch on in the next section. If you get the next slide, Greg. What are some of the things that you can actually invest your SRS in? So you can invest in Singapore listed stocks, which includes REITs and ETFs that are listed on SGX. You can invest in SGX listed retail bonds, Singapore savings bonds, unit trusts or mutual funds, which is what Endowus offers in our portfolios, insurance products, and deposits. Within this unit trust universe, it's actually very, very broad in the types of markets that the unit trusts are invested in. Right, so you can invest in global markets across different asset classes, sectors. You can invest in equity funds, fixed income, money market. It's a pretty diverse universe of funds that you can look at. You go to the next slide. So just highlights of SRS facts that you should know if you are thinking about contributing to SRS. If you want the tax relief for your next year's tax assessment, you do have to contribute by December 31st. And as Greg mentioned before, your employer can contribute to SRS on your behalf as well. So make sure to check in with them. And this is considered part of your remuneration. The last part is, you can actually contribute, you can contribute $1 to SRS, right? And that will enable you to lock in the current retirement withdrawal age of 62. And it also starts the 10-year contribution count for foreigners.
Okay. Cool. So, sorry, there's a question here, Cindy. Interested in discussing SRS redemptions when I would be a non-resident in Singapore, the retirement age of 62. Which tax rate applies?
The non-resident tax rate applies, which is higher. So when you take the money out at the age of 62, it would depend on whether you were a tax resident or a non-tax resident in Singapore at that time.
Okay, cool. So that was really heavy duty SRS stuff, guys. Kind of like we'll have to spend some time going back and going through those slides and maybe listening to snippets. I think the long story short of it is that SRS, in almost every way you cut it, is a beneficial program with immediate tax savings. There are certain scenarios where if you have absurdly high investment returns, where SRS could be a disadvantage. You can read, we've done some calculations on this on Endowus Insights. So you can go check that out. It's for and we've done some sensitivity analysis on at what point, with what return, for what duration will SRS be less beneficial as a tax efficiency tool. So go to endowus.com/insights. There's an SRS tab, and you can read a bunch of SRS articles and insights that we've put together there. Okay. Now, as a foreigner, I left out CPF in this part of the presentation. We're just going to go through some fundamentals of how to invest your cash in SRS. And it's really about defining a scientific approach to your wealth, not one that is speculative. And it really always brings us back to the basics. So I remember when I was in college, we had a guest speaker who was one of the great hedge fund managers. So I was at the University of Pennsylvania, which is very famous for the Wharton School of Business. Sinting actually just happened to go to Wharton School of Business as well. And we were very lucky to have Howard Marks speaking to a very small group, like maybe 100 students. And Howard Marks is one of the most famous hedge fund managers in the US, a self-made billionaire, famous for his firm Oaktree. And the very first question he asked the audience was, what is the most important thing when it comes to investing? And some smart kids in the front row put up their hand and said, it's the quality of the CEO, or the quality of the company, or the sector that you're investing in, and things like that. So that's immediately where people are drawn. But actually, he said no. Just so happened, my friend who was sitting next to me put up his hand and said, it's the price. And Howard Marks, so the price of a stock. And Howard Marks goes, yes, you're right. And my friend said, oh, I only know that because I read your book. So what does that mean? Every day in markets, there's hundreds of billions of dollars being circulated trying to find price. So the price of Amazon today, or the price of Tesla, or the price of GameStop, or the price of DBS or Singtel, for example. the prices are being bet on by the market participants, right? So that's you and me, the funds, the sovereign wealth funds, the pension funds, the school endowments. Everyone is participating in these markets trying to find price. And everyone thinks that they're getting, they're buying at a good price. And the people who are selling think that they're selling at a good price. And that's how securities prices move up and down all day and every day. So the issue with this is that it's been proven over and over again that professional investors struggle with this. And professional investors means like professional fund managers. So the Wall Street Journal did an expose on Morningstar ratings in 2017 and said that, if you were a 5-star rated fund today, you only have a 14% chance of remaining 5 stars in just 3 years' time. So that's an extremely low persistence of returns. And it makes you think, like, every time I've been to a bank branch or every time I've been sold a fund, they've always showed me this fact sheet and said, look, past 3 months returns are fantastic, maybe up 20%. And this star is 5 stars, right? So there's a big 5 golden stars on the top right-hand corner of this fact sheet. And it's very easy to get excited about that. What I'm saying is that chasing 5-star rated funds is not a very good or very evidence-based investment strategy. So don't get lured into that trap. Now, for individuals, the situation is even worse. The average investor consistently performs over longer time periods around inflation. Now, that's really upsetting when, for this 20-year period, stocks did, over 4%, around 4% more than inflation, or had a real return of over 4% more, of 4%. And if you look back at history for hundreds of years, equities tend to do better with more volatility than inflation or cash or fixed income. And there's a relationship here across different asset classes. So the critical thing about evidence-based investing, which is what Endowus is really trying to help people achieve, is that the markets can work for you if you position yourself properly within them. Now, when you take more risk, you are going to subject yourself to more volatility, and that's natural. The US has the longest historical data, high quality data on markets. So, if I invested $1 onto my mattress, so I put it in my mattress in 1926, before the Great Depression, it would still be $1 today. I mean, a half disintegrated dollar, basically. And it would be able to buy a lot less than it would have bought in 1926. And that's the power of inflation. Now, $1, if I matched inflation, would have become $15 by earlier this year. If I invested in US Treasury bills, which are very considered safe short-term government bonds, $1 would become $22. If I take slightly more risk and invest in long-term government bonds, so that means I'm increasing the uncertainty, $1 would become $188. Now, I've invested in stocks, so global stocks. This is represented by the S&P 500. $1 would have become over $11,000. And then if I took even more risk and invested in small cap stocks, $1 would have become $38,000. I mean, that's mind-boggling, and that is the power of inflation. So imagine if I invested $1,000 in 1926, $1,000 would have become over $37 million in this period. Okay. Now, why does this relationship exist, and how do I take advantage of it? That's the question. And how do I position a portfolio or multiple portfolios that play the risk, that are able to take what we call compensated risk in exchange for higher expected returns? And that is what we help our clients do at Endowus. Now, if you take a step back and think about this more theoretically, this relationship just makes sense, because if a company were to go bankrupt, the bondholders would get paid back before the stockholders. And what type of companies are more risky, small companies or large companies? The answer is small companies. So therefore, small cap investors are able to achieve a higher expected return. This slide, so this is what, in the academic world they call the efficient market hypothesis, which won the Nobel Prize, I believe, in 2013 to a gentleman named Gene Fama. And he carried on to co-create something called the Fama-French three-factor model, talking about basically relative risk of different types of securities that you can invest in. Now, another thing is people like to pick, sectors and geographies, and it could be the case where all the signs are pointing to that something must go up. I mean, I think at the middle of last year, that something was China. But it's extremely hard to concentrate your portfolio and take advantage of markets successfully. So returns are random. This is a sign. This is showing you developed market returns year by year. So you can see Singapore plus 99% in 1999 to negative 27% in 2000, and fluctuating greatly across the year to year. And in our view, you don't need to play this game, especially when it comes to your core family wealth. Similar thing with emerging markets, very, very colorful chart, very beautiful chart, but impossible to guess what will happen next. So what we do at Endowus is we have a number of portfolios, or you can even self-construct your own portfolio based on a list of curated funds that we've selected that we think represent certain themes, like maybe technology or China, the best. And these are managed by professional managers. So really quickly, I'll just quickly jump into what we're talking about today. So I'm back to the Endowus website. We try to be extremely transparent about our solutions. And you can go to Invest With Us and How We Invest, which is this page, and you can see our various options. So we have core and ESG focused portfolios for cash, CPF, and SRS. So SRS is that bucket of money that Sinting was speaking about earlier with tax relief. You can save better with Cash Smart. So we have cash management solutions at varying levels of volatility that earn you up to 2% per year on your Singapore dollar returns. And then Fund Smart, where you can buy single funds or customize your own portfolios. We'll talk specifically about our core portfolios today. Again, you can select between cash, CPF, and SRS. So we're talking about cash, which is the same as SRS. And you can transparently see across the risk spectrum from 100% stocks to 100% fixed income, the returns of these portfolios. So I want a 60-40 portfolio, which means 60% stocks and 40% fixed income. This is what I see. So we transparently show you returns year by year. You can see, the return from that starting point, how much you would have accumulated. You can come down and see even annual returns. So we espouse a strategic passive asset allocation, one where we're not tactically trying to change your portfolio to beat the market. We think you need to be set in your level of risk and stay in that level of risk to be compensated. What I was talking about a couple of slides ago here. So you need to figure out or we will help you figure out the combination of these global securities so that you can harvest longer term returns. Coming back, we also, from here, you can see the underlying funds in the portfolios. In the case of Endowus, we access institutional share class funds, or if we access the retail share class, we return 100% of trailer fees to you. Trailer fees are a kickback that is often given to distributors. So we're trying to really disrupt a model that we think puts an advisor or a broker or even a fund platform against its clients. At Endowus, only our clients can pay us. We cannot get paid by anybody else in the system. So we're not pushing product to you. You can see the underlying funds in the portfolio. Dimensional, traditionally a very institutional focused fund manager. We've worked with them closely in Singapore to launch a number of products here. PIMCO, the biggest fixed income manager in the world. We've launched a number of Singapore dollar hedged institutional share class funds with them at a significantly lower cost than you could get on any other fund platform in Singapore or even globally for most investors. We've also worked with them to bring, or we are also able to access portfolios that are hedged into other currencies like US dollars, GBP, Swiss francs, and we have a number of clients that are allocated to that because they have liabilities in those currencies. So at Endowus, it's all about creating portfolios that are most suitable for you, whether you're in Singapore or abroad. So do come here and check out our portfolios. You can see the top 10 holdings and look through to that, the country allocation of the portfolio, how it's broken down by sectors, all transparently on the Endowus website before even creating an account. The account creation and we really try to be very transparent about all this. So coming back to the presentation, let me just skip back ahead. So in your world of Endowus, we try to precisely define your goals, and those could be goals where you say, I have a home in Europe that I'm saving up for. So we would say, okay, well, let's create, and we do this for our higher net worth clients. Let's create a portfolio of, euro hedged and euro denominated funds. Or I have a down payment that I want to, buy. I want to buy a home in Singapore. We create a portfolio for that. You have a process for achieving your goals, and you have access to the experts at Endowus, the experts in terms of the fund managers and the strategies which are implemented by these global practitioners to achieve your goals. And that's what we really hope to do for you. So again, we're about providing the systematic, strategic passive advice, access to funds, standing on the shoulders of giants rather than trying to reinvent the wheel. We're not trying to sell our own funds. We're trying to put together the best funds available in this universe available in Singapore and construct them into a portfolio that is suitable for you at low and fair cost. Finally, we have no transaction fees, no sales charges, and we did this on purpose because if we had these fees, we would immediately be incentivized to move your account around. So we don't really want to do that. Additionally, we've innovated the 100% trailer-free rebate. So those are the kickbacks being given back to you. In some cases, these kickbacks can be as high as 0.6, 0.7, 0.8% of your total assets invested in a particular fund. So it's not a small amount. And with all of that, Endowus is the first and only way to invest your CPF, SRS, and cash holistically with expert advice towards your life goals. So that's really what we're doing here. When you work with us and when you work on the platform, you can create portfolios at different levels of risk towards these different liabilities. And we have a team of MAS licensed representatives headed up by Sin Ting, who is on the call today, our Chief Client Officer, who can, if you are struggling to do so on the platform, if you have questions, you can reach out to, and who will help you along. So our whole philosophy is to really take control of what you can control and not focus on what you cannot control, which unfortunately is what we see a lot of people doing. It's very distracting to be driven by the news. It's very distracting to be driven by friends who made a lot of money last night on some option trade or some crypto trade. We're really focusing on your core family wealth and applying a very scientific approach so that you can benefit and your family can benefit by planning now and staying true to this investment philosophy. So definitely you need to control your cost. Definitely you need to invest in your career, because that's what's going to give you more wealth, which you can then put into a plan. Definitely you need to be diversified, because concentrated portfolios will basically have very random outcomes. And Endowus builds tools to help you do this seamlessly across an app or a web platform. Of course, we're MAS licensed, and yeah, so it's been a couple years, and just recently we're very, very proud to announce that we've created over 100 million in gains for our clients by applying this method of investing, this very scientific method of investing. Last sort of topic for tonight is UCITS versus US listed securities. So this is a very wordy slide. You can always come back to it and pause the video and read it in more detail. We're not tax advisors. We approach this from an investment perspective. And when we select funds or construct portfolios, we're always thinking about what makes the most sense for investors based in Singapore. Now, if you're a US person, this does not apply at all. So a US person means that you hold a green card, you're a US citizen, you're a US resident. This does not apply. None of this applies to you. You are subject to US tax. But what I want to talk about is a type of fund structure, which is very, very popular, especially in the institutional world, where you can avoid, or not avoid, you can reduce your tax liability when investing. So this is called UCITS, founded in Europe in 1985, and it's to create a way for first European investors, but this has now been applied to global investors to invest in basically a fund structure that is more tax efficient. And I'll give you an example of that later. So currently, if you invest in US listed ETFs, you will pay 3 levels of, I think there are 3 types of tax that you need to be worried about. There's a portfolio level tax, a fund level tax, and then an estate tax. The individual level, I don't think you can avoid, because the investor level you cannot avoid, because you, the investor, will always be the same person. So the portfolio level dividend withholding tax is from, for example, and I'll show you guys an example of this after this slide. But if I am a US listed ETF investing in China, then there will be a withholding tax between the Chinese company issuing dividends outside of China to a US company, which is the US listed ETF. Okay, so that's portfolio level. And then there's fund level. So now I'm a Singapore-based investor investing in a US company, which is investing in the Chinese company. And there's an additional layer of tax between me and the US company and the dividends that I should be receiving from that US company. Now that tax between Singapore and the US is 30%, which means that if the dividend is 3%, 30% of that 3% is being withheld, and there's nothing I can do about it. So that's 0.9% additionally is being withheld. Okay, then there's also estate tax. Because you now own a US security, you are subject to estate tax of up to 40%. Now that's kind of the law. We're not tax consultants, and we're not tax lawyers, but these are the risks that are well known when investing in US listed securities. So when you invest in what Irish UCITS funds or Luxembourg domiciled funds, yes, your US sourced income. So if I am a UCITS fund now investing in US companies, of course, I'm still going to be paying that US company tax of 30%. For some structures, there is an even further tax treaty to reduce that. But what I'm going to avoid is the fund level withholding tax. So from on the ETF side here, from the US company to me in Singapore, where I'm paying an additional 30%, for the UCITS funds and ETFs, so Endowus invests in a lot of UCITS funds on behalf of our clients, there is no additional withholding tax. So that's immediate savings for you, immediate cost savings. Beyond that, the UCITS funds are a bit more flexible in that they can automatically reinvest dividends and income to make it a lot more efficient for your investment planning. The US listed ETFs are forced to distribute their dividends and income, which can be inefficient because you may not need that. You may just want to accumulate those dividends and income into the future. So kind of a heavy duty slide, but we're talking about real savings. So for example, when you buy a US listed ETF, you have a few things to consider. You have the fund cost, the trading cost, and the bid-ask spread. So the fund cost is the fee that the ETF manager charges. And those are very, very low now, and we all know that. But then there are additional costs. So there's a trading cost. You need to buy it through a broker. So what is that broker charging you to go in and out of that ETF? Then there is a bid-ask spread, right? So ETFs are allowed to trade within a band because they have intraday liquidity rather than at the net asset value of what you are buying. In Endowus, we like to buy at the net asset value to avoid the additional sort of uncertainty around that bid-ask spread. So let's say the total cost of all that is around 0.5%. Then you receive a dividend of 3% from these Chinese companies. So China will withhold 10% of that 3%, so 0.3%. And then, so now you have 2.7% flowing into this US company. But then when that 2.7% gets distributed back to Singapore, where you're based, 30% is withheld. So now your total tax withheld is now 0.91%, of which the second part, the 30% from the Singapore-based investor receiving dividends from a US company, is actually avoidable. So when you are buying UCITS funds, which are more tax efficient, and particularly UCITS unit trust, which is what we are paying for, which is what we advise many of our clients to invest in. You reduce the trading cost, the bid-ask spread uncertainty, and the additional layer of withholding tax between the Singapore-based investor and the US listed ETF. Now, ETFs have a fantastic rep, and I think they've done an amazing job in bringing efficiencies to the investor. But a lot of people without an advisor are not aware of some of these additional costs, and this can pile up, and at times may defeat the purpose of trying to be low cost in your solution. So there are a number of robo advisors in Singapore that invest almost entirely in US listed ETFs. Now, unless you're a US person, that is an extremely inefficient way to be accessing the global capital markets. Because now not only are you paying the additional, not only are you unnecessarily paying withholding tax, you are also paying an additional fee wrapper around all of that, and your total fund cost or your total cost of investment is very, very high. So if you are doing that, I urge you to look into it, do some research into UCITS and how you can benefit. So,
Greg, there's actually a question in the comments about what you just mentioned.
okay.
Are you referring to ETFs like KWEB in this example?
I don't know the exact dividend from KWEB. So for people who, where are you seeing these comments? I'm just curious. But for
On the right next to private, like
okay,
in the
okay,
chat section.
awesome.
Yeah, I just
Okay, got
discovered
it.
this.
Yeah. Well, KWEB is an extremely concentrated ETF, which, as many have seen, has gone from $102 in February this year to now $50, and happened to be, quite a large percentage of one of the robo-advisors' portfolios. And I think they've really suffered by making such a concentrated bet. So I would never, I think it's a really concentrated play. It's also expensive. It's 0.73%. And it is also a US listed ETF. So if you were to get your China exposure through KWEB, you're being extremely, extremely inefficient, because your dividend withholding tax would be subject to 10% from China to the US, and then the additional 30% from Singapore to, from the US to Singapore. So your total tax withheld would be 0.91%. KWEB would then add on top of that, the fund cost is 0.73%. And then additionally, because it's a less, it's a more unique ETF, you tend to see bigger bid-ask spreads as well. So to me, it's just not a very good way of exposing yourself to markets. And I think it's a very concentrated bet on Chinese internet, and inappropriate unless you really feel very strongly about Chinese internet, in my view. Yeah.
So it probably, it's not something that you would look at in your sort of core portfolio, but if it's something, as Greg mentioned, that you do feel very, very strongly about and you want like a satellite additional exposure, then it's something you could look at. And we also have UCITS China A-share funds on our platform, which we think is a more tax efficient way to access this part of the market. There are a couple more questions. Hold on, I'm just gonna scroll. Okay. So there's a question from Rohit. Would expats or individuals investing from outside of Singapore be charged capital gains tax? So you would not be charged capital gains tax from IRAS, the tax authorities here, but it would really also just depend on what your individual tax circumstance is at that point of time and what your tax domicile is. And again, we're not tax advisors, but in terms of the Singapore tax implications, it's fairly straightforward here. And there was another question on estate taxes, inheritance taxes. Unfortunately, we don't have any visibility on this, but if it did, if it was implemented, then it is likely that, stocks and unit trust would also fall into that category.
Okay. People, when we were preparing for this webinar, I think we try to think of a few questions that people often ask us. So clients often ask us. So Sinting, what happens if I leave Singapore?
So this is a really important question, right? Especially for an expat. So you really have to, you have to ask your bank, your investment platform, your brokerage this question before you open an account, right? Would you have to close your account if you ever have to leave Singapore? For Endowus, the answer is no. You can keep your account even if you leave Singapore. There are a few exceptions to this, though. If you move to the US, unfortunately, that becomes a problem for us because at the moment, we cannot accept US person. And if you move to a sanctioned country, then we would also need to close your account. But for most other jurisdictions, for us, it wouldn't be an issue.
Another one, should I keep my investments in Singapore dollars after I leave?
I mean, for me personally, it would be something that I would do. And I had shared this in the beginning of the presentation as well. If I left Singapore one day, I would leave my Singapore bank account as an offshore bank account. Right. A lot of people do have offshore bank accounts. It does make it easier to keep your money in, a central location, wherever life, takes you after Singapore. And when you're looking for an offshore bank account, some of the things that you should look at are, a low tax jurisdiction, a country that has economic and political stability, and a stable currency. And Singapore obviously checks a lot of these boxes. We're the Switzerland of Asia. And, Singapore has a lot of regulatory checks in place for the financial system. What about you, Greg, if you left Singapore one day?
I mean, for me, it really depends on where my liabilities are.
Yeah.
So if I was moving, to, let's say, Hong Kong, which is now pegged to the US dollar, or maybe in the future, that may change and it may get absorbed by the Chinese yuan. You want to maintain purchasing power in where your life will go, right? So, right, I mean, I think Singapore dollar is a great currency, and I don't think it's going to be very volatile compared to other major currencies, which makes it very, very attractive, right? And that's why, if you're a Singapore-based investor and your liabilities are in Singapore, your fixed income portfolio in particular has to be Singapore dollar hedged, right? Because fixed income in general is for nearer term liabilities, and you don't want currency volatility to interrupt your plans. And we actually have another article about currency on endowus.com/insights. And when you do not hedge a fixed income portfolio to your liability currency, so if I did not Sing hedge, if I just bought my fixed income exposure through, for example, UCITS ETFs or ETFs in general, most of which are in US dollars or GBP or euro, the volatility of returns that introduces to me as someone with liabilities in Singapore makes it almost as volatile as stocks, but with a much lower expected return. So that makes very, very little sense to me. And I talk to a lot of clients who start off in that position and come to this realization and really adopt, hedging your fixed income exposure. Now, in your equities exposure, it's actually a different story. In your equities exposure, you generally would not hedge, and you would take the underlying currency risk of this globally diversified portfolio that you have. So if the portfolio is 50% in the US, you're basically 50% exposed to US dollars. If it's 10% in Japan and then like 8% in China or whatever it is, you'd be exposed to these global currencies. And the reason for that is because equities are for the longer term, right? And you are investing in the world with your equities and where that world is going. Okay. Also, if you hedge or do not hedge, it actually does not change the volatility of returns very much when you bring it back to your denomination currency. So to me, again, equities to me doesn't matter what currency I'm in, because ultimately it doesn't matter my denomination currency, because ultimately I'll be investing in whatever is underlying in that portfolio. But for fixed income, and particularly for like cash management or shorter term liabilities, like maybe I have a house down payment in 3 years, or I need to buy a new car in 2 years, or I need to do X, I need to pay for education in the US for my kid starting in 5 years' time, I would definitely consider a portfolio that is hedged to that underlying currency. Yeah. So my answer is it depends. If I don't have any liabilities in Singapore, then I don't I don't have a view on the Singapore dollar, then I wouldn't keep anything in a Singapore dollar hedged portfolio. For me, it's always about positioning my portfolio. So it's always about positioning my portfolio for my future, right? So bucketing my money into these various goals and investing systematically towards those goals at the correct level of risk. And in this case, in the correct currency as well. Okay. Sorry, I'm just going to look through if we have any more last questions. I know we're a bit over time. Okay. So we have a question from David on Facebook on what is the withholding tax of a portfolio. What is the withholding tax of a portfolio on Endowus? So on Endowus, we're looking at, let's come back to here. We're dealing in primarily UCITS unit trusts and Singapore domiciled unit trusts. So what you are able to avoid versus the US listed ETFs is right here, the fund level withholding tax, which is 30% on all income or dividends, irrelevant of source of country. So that is for me as a Singapore-based investor, facing a US company and 30% of my dividends and income being withheld by the US government when trying to leave the country. So on Endowus, we are being much more tax efficient in that way. Tax is very, very complicated because countries have tax treaties. So certain countries may have tax treaties with Ireland or Singapore or Luxembourg, which is where these funds might be domiciled as well. And they may have, tiered tax treaties. They may have tiered tax systems. They may have different withholding taxes for different industries. So it becomes very, very complicated. But what I think we can do is get the broad structure right by, avoiding US listed securities if we can. If there are alternatives that are low cost and represent the exposure that we want as well, if not better. Okay. Thanks, guys. Really quick.
Sorry, go on, Greg.
Really quick shout out again for our webinar next week. At Endowus, we are helping people. We're making investing more accessible. We're making wealth management more accessible, more convenient, more transparent. And we do this not by offering our own clients. Not by offering our own funds, but by looking at the entire universe of funds. So I just learned that there are over 9,000 funds in Singapore alone. 9,000. It's crazy because there are 9,000 funds in Singapore. There's only about 15,000 investable stocks in the entire world. So and then you add on like the ETFs that are available across the world, the funds that are available in every country, and the number of funds and ETFs, which are basically combinations of these securities, far surpass the number of securities that actually exist, which is kind of a crazy thought. But anyhow, what we do at Endowus is try to curate this list and find the managers who we think are are doing a very good job in providing exposure to certain asset classes. We spoke today mostly about our core flagship solutions, which are always globally diversified, optimized to lower cost, optimized for tax efficiency, optimized to be Singapore dollar or Singapore dollar hedged, or if you have another currency that you want to invest in, you can reach out to us at support@endowus.com, and we can help you structure portfolios in other currencies. Next week, we have a webinar on with two China managers, Aberdeen and Allianz. These are active fund managers, and so we're very clear on what is active and what is passive. These are definitely active fund managers, and they will be sharing their strategies and also the current environment in China, which has been turbulent, to say the least. I mean, I think we talked about earlier, KWEB is down by 50% since February. And KWEB is targeting Chinese technology. A lot of people and some of the robo-advisors were heavily exposed to KWEB and were penalized for that level of concentration. So China's growth and regulatory risk, join us next week with Allianz and Aberdeen Standard. Okay.
Thank you so much for spending your Wednesday evening with us. I think there were a couple of questions that we didn't get to, so really sorry about that. But if you drop my team an email, support@endowus.com, we'll definitely get back to you there.
Thank you, Sinting. Have a good night. Thank you, everyone.
Bye.